Hello and good afternoon, good morning, everyone, and welcome to the opening of our Global Macroeconomic Conversations. This is a conference that we have been hosting with UBS for so many years during the IMF and World Bank Spring Meeting and during the annual meeting of the World Bank and the IMF. And we hope that we can meet again soon in Washington, maybe next year, and also to welcome all of you again to our regular conferences. It's a great pleasure to welcome our panelists and speakers. We will kick off today with our first session on emerging market. Tomorrow we will have another session about the advanced countries with the President of the Federal Reserve Bank of Dallas, President Kaplan, and Olli Rehn, the Governor of the Bank of Finland. And on Thursday, we will discuss a topic that is becoming more and more important for central banks, the state of central bank digital currencies. Today, we are going to look at the state of the global economy, particularly through the angle of emerging market. A lot of discussions have been already taking place over the last few months about the different episodes of capital inflow and capital outflow in terms of the policy tools that emerging markets have at their disposal. And of course, we all want to hear about the economic consequences of the pandemic for the emerging market. There was a driver of global growth. That's not going to be the case anymore. We are going to see maybe a divergence of the global economy and concern also about another type of super tantrum episode. Welcome. Thank all of you, central bankers, academics, for joining us. And I really appreciate your participation today. And I'm very pleased to welcome Massimiliano Castelli, Managing Director of UBS Asset Management, who always have the tradition to moderate and to share the session on emerging market. Max, over to you, and thanks again.
Thank you very much, Mark, and welcome to all our panelists, of course. This is my second macro conversation on the side of the IMF World Bank meetings in virtual. We are hoping that the next one in October might be in person, but of course we are in serious doubts about that. We hope for the best. Eventually we will be in person in Washington, D.C. It will be a pleasure to do this in person rather than virtual. Say that, I would like really to kick off this panel. Maybe before I kick off, let me say a few words, first of all, about the questions that our participants can ask. I already received some questions in advance from the registered participants, but of course you can also ask questions now live during the panel by using the email address at the bottom in the banner at the bottom of the screen. Now, this is, as Mark mentioned, the first of three panels that about the economic consequences of the pandemic, and with very much a focus on emerging market. For me, this is very important, and as Mark mentioned, I am always involved, particularly with emerging market, because in my role as head of strategy for sovereign institution, I mainly deal with the central banks, sovereign wealth funds, and over state control investment vehicle. The majority of our clients are indeed in emerging markets and come from the emerging market world. So this is, of course, a topic very much close to our business as well. I'm actually very lucky today because I have not only a very distinguished panel, a group of panelists from the official sector and from academia, but I also think I have a very good wide range of countries represented. So we will be able actually to provide a very nice global overview with different perspectives from different regions. Now, of course, the way Mark was right when he said that emerging markets, actually, they've been doing relatively well during this pandemic. In particular, there is always this comparison with what happened in 2012-13, when the volatility in advanced economies had a very large impact on emerging markets, the famous taper tantrum. Actually, we are living once again a situation like that, with the tension in long-term interest rates in the US, which are actually having impact across global interest rates as well, because it's not only the US rates, long-term interest rates that are rising, but also the one, for instance, in the UK. And there is also some tension appearing in the euro area as far as the long-term interest rates are involved. In reality, if you compare the period, the impact which we saw in February and March in terms of capital flows has been relatively muted. For sure, there has been some volatility and some slowdown in capital flows, but appears to be a relatively short-lived transition phase, which has already stabilized. I was looking this morning at the latest data from the IMF, showing the global capital flow to emerging markets have came back. At least they're not anymore in negative territory. But of course, the challenge remains. And the challenge are, I would say, different one. First of all, there is a widespread view that the recovery in emerging market is going to be slower than in advanced economy, largely because of the slower distribution of vaccine, which is going very fast, particularly in the US and the UK, and eventually will be the same in Europe if we will be able to catch up with the US and UK over the next few months, I would say. The strong recovery in the US, of course, supported by the vaccine, but also by an unprecedented fiscal expansion, is creating tension on the long-term interest rates. I mean, I always very careful to extrapolate from short trends long-term implication. We should keep always in mind that the long-term interest rate in the US so far are basically back where they were before the pandemic hit the global economy. Actually, in the UBS Asset Management, this is a very big topic that we are discussing with our clients. We actually made some estimates, and a gentle rise in long-term interest rate associated with a strong recovery would actually be well absorbed by the market, and I believe would not impact dramatically emerging markets. On the other hand, instead, a more rapid rise in long-term interest rate, actually we estimated in 2 times the normal standard deviation, would actually have a negative impact in terms of risk. It would impact equity market and would eventually increase risk aversion among investors and eventually slow down flows into emerging markets. So, I mean, this is the topic of today, how emerging markets are dealing with the impact of the pandemic and all the fiscal and monetary policy response that we are observing in advanced economies. I would like to mention 2 very important points. One, there is, which could also be a surprise, on which eventually I would like also to hear the view of our panelists. The first one is about the dollar. The consensus view is that the US dollar will weaken. I mean, I am an old economist, but I'm always very cautious about making forecasts on exchange rate because the margin of error is very high. I wouldn't be surprised if this weakness of the dollar on the back of the strong recovery in the US, some of the numbers coming out of the US are pretty staggering in terms of the strength, could actually well be that this weakness will not materialize. And of course, this has very important implication for emerging markets. The second point, which I think it is also very important, is about the policy response. And in terms of particularly the ability of emerging market to eventually being in a position to continue with the counter-cyclical type of policy, for instance, in monetary policy term, to support the recovery as time passes and the vaccine are gradually distributed, how this will change if, for instance, the US interest rate continue rising from the level we are now. So without further ado, I would like to immediately kick off. I will ask all our panelists to make some introductory remarks, and then we will open for a Q&A. I would like to invite Professor Ṣebnem Kalemli-Özcan to lay the ground by giving us an overview of where emerging markets stand at the moment. Professor, the floor is yours. Please go ahead.
Thank you very much, Max. It's a pleasure to be here speaking at this panel with very distinguished guests. Let me start by saying that emerging markets are not out of the woods. I wrote 2 papers a year ago, April 2020, and basically I said this can lead to biggest emerging market crisis ever unless there is a tremendous response from US monetary policy that will stabilize the capital flows. And I wrote this during the time when capital flows coming out of emerging markets, April 2020, May 2020. And it exactly happened as I conjectured. US Federal Reserve put out a tremendous amount of global liquidity, much more than what they did after Lehman crisis in 2008. And that, of course, helped emerging markets tremendously. Initial capital coming out of emerging markets in April, May, June of 2020 was the riskiest asset class, portfolio equity. and also sovereign government bonds, sovereign debt, because that's local currency, and obviously that was a depreciating asset. So basically the riskiest asset class, but flows didn't come out of banking sector, flows didn't come out of corporate sector, which is now the bulk of emerging market debt, actually. I mean, we have to make sure we understand difference between emerging market and developing countries. Emerging markets now, private sector, banks and corporates borrowing dollars overseas directly, where their sovereigns and governments mostly borrowing local currency. Of course, at the time, we didn't understand this because we don't have real-time data on capital flows. IIF data or EPFR data, these are portfolio flows, right? Portfolio equity and portfolio bond. And portfolio equity is not a big class for emerging markets external borrowing. It is really about bank debt and corporate debt. And if you look at what happened during Lehman crisis and during taper tantrum episode, May 2013, what crashed emerging markets, especially the vulnerable ones, are the capital flows out of the banking sector and corporate sector. And this didn't happen thanks to, as I said, US Federal Reserve, that put out a tremendous amount of liquidity, global dollar liquidity to the picture. Okay, this is what happened. But again, coming back to my point, emerging markets are not out of the woods. I actually still expect a crisis, not like maybe a serious one, a fast, sudden stop type, like we will wake up one morning and we are seeing these emerging markets falling like dominoes. I don't think that's going to be the case, but more a slow-moving crisis, as now the way it happens in the new age with floating exchange regimes, which most emerging markets have. And why do I think that? First of all, let's not forget the size of the COVID shock. COVID is a very large shock, and it is a multitude of shocks to emerging markets. It hits their demand, it hits the supply. There is a whole health side of the shock domestically going on that emerging markets governments have to deal with. On top of that, there's a financial element which directly links to capital flows and exchange rates. So we just have to picture that. I mean, the size and the multifaceted nature of the COVID shock, and the fact that emerging markets have limited fiscal space. Okay, fiscal space is very limited. If you look at what advanced countries put up so far, it is almost around 35-40% of their GDPs in terms of the entire package. And what emerging markets put is not more than 6-7% of GDPs. Even you look at the emerging markets within G20, this is also in the new paper on global equitable global vaccine distribution we show this limit to the fiscal space is very small. Even you're an emerging market in G20, it is not going to be more than 7% of GDP. So there's a huge difference in terms of fiscal space. And this comes with this backdrop of external debt, both in local currency, their own currency, and in foreign currency. And in fact, there are several emerging markets that this debt is really big, and it has to be rolled over. I mean, just last year in 2020, we had 4 emerging markets where the private sector FX debt that needed to be rolled over, which is short term, at the end of 2020 was over 20% of their GDP. So these numbers are huge. There is no way anybody can come up with those type of funds, which is why this intersection between domestic fiscal space and capital flows is very important. Capital flows at this point is basically a lifeline to emerging markets, because otherwise they are going to have all sorts of crises, starting with the rollover crisis on their private sector dollar debt. Now, the last point I want to do here is on the policies you mentioned. So even with this environment, there are several emerging markets, I think 13 of them, did their own versions of QE. Not only they did countercyclical monetary policy, they cut the short-term policy rates at the beginning, as everybody doing in the world. They also, on top of that, even none of them at the zero interest rate, zero lower bound, on top of this reduction in their policy rates, they started a QE program. Now, there I think we have to be very careful, right? And I'm sure you remember when these 13 emerging markets started this last year, quickly many people said, oh, this is debt monetization, this is going to be inflationary, that's going to be the end of the world, because emerging markets spent 2 decades now on very successful inflation targeting regime and earned policy credibility. And this QE type of policy is very dangerous because they are going to lose this policy credibility. So First of all, I don't agree with the critique right away, because I think there are many emerging markets with great central bankers, as we have today with our guest. They have monetary policy credibility, and they can do QE. I mean, there is no such thing that only advanced countries do QE and emerging markets should stay out of it. There is no such thing. I mean, any country can do QE, but again, the trick is the policy credibility, right? Why QE policies are successful? Because you have a handle on inflation expectations. If you have an handle on inflation expectations, which is basically the way we call in advanced countries forward guidance, then you can have very successful QE policies. And we actually saw this. I mean, within this many of emerging markets, the one with monetary policy credibility succeed with the QE programs. Not only they raised extra funds, their external finance premium actually came down, which means capital flows kept flowing in, which is very good development. Of course, there are others where they lost monetary policy credibility before. These are the high inflation countries, of course. I'm going to give example my own country, Turkey. Those countries, QE, cannot succeed because you already don't have monetary policy credibility. Inflation expectations already the anchor. Inflation already 50% above the target. In that environment, of course, it is very hard to do these policies. So let me maybe stop here, and then I am going to answer your last question after other panel speakers in terms of the exchange rate and what other policies available to emerging markets, because this is also an important conversation linked back to monetary policy credibility. I would like to get it back after all the panelists had a chance to speak. Thank you very much.
Thank you very much, Professor. Actually, I think if I can try to summarize what you said, I think you made a very important point. Maybe we should not focus on a sort of a tapered tranchum 2.0 as a sort of a short-term threat, but actually focus on the long and medium to long-term implication of the COVID on emerging market. And you mentioned some of them, which are very important. The slow recovery, of course, the rise level of debt. And also, I would actually stress the long-lasting damage done by COVID in terms of economic activities, which sometimes is completely neglected, not only in emerging markets, but in advanced economies. I think that's very important, and we can come back to the question of the exchange rate and the level of interest rate maybe later on. So I would like to immediately to pass the floor to Ksenia Yudaeva, who is the first deputy governor of the Central Bank of Russia. So please, Ksenia, the floor is yours. Go ahead.
Well, thank you very much, Mr. Milano. I think that I agree with those who say that this year we will face slightly different challenges than last year. Because what happened last year? First, there was a huge spike in volatility. So everybody was concerned with stabilizing the market. And some of the QEs, I actually think that QEs in different emerging markets were different. There were different classes of those, right? I think some were closer to QE in developed economy because interest rates were already close to zero. Others were more of financial stability types, and there were even some which were close to budget financing through central bank money. But anyway, so restoring financial stability was the biggest topic about exactly 1 year ago, slightly more than that. And of course, Fed and ECB helped a lot with their policies, but emerging market countries to make the effort as well, and it was also helpful. And then, of course, there was a topic of support of the economy, preserving continuation of credit going into the economy, financial system functioning, debt restructuring, right on the way, on the background of not working economies and so on. So a central bank like ours, which is not just monetary policy, but also financial regulation, not only we went to substantial easing of monetary policy, we also provided a number of temporary regulation forbearance measures, and we by now we got out of most of them. Some of them will still be working until the 1st of July. And we also released some of the buffers in the financial systems which were accumulated and so on. So I think that this year we face a new challenge. At least in Russia, we see it quite obviously. And I think that in some countries which are present at this panel, maybe not in all of them, is pretty clear. It is inflation, global increase in different food prices, and not only food prices. And so last year, inflation was very low. So many countries argued that they can decrease interest rates because inflation is unprecedentedly low. But this time around, it's gone quite high or keep growing quite fast in some countries. In Russia, it's already overshooted our target substantially. Our target is 4%. Inflation is 5.7%. So I think that this year many countries face several trade-offs because of that. Right, it's monetary policy trade-off. Right, as you said, economy not everywhere is out of the woods yet. Right, so shall central banks ignore this inflation spike in monetary policy, or shall they start thinking about inflation expectations which are on the rise due to this increase in inflation? Second trade-off is kind of leverage trade-off, right? I think the challenge for financial stability is not just capital outflows or capital inflows. Just the pure fact that long-term yields are higher means that refinancing some of the debt by corporate and by governments is more expensive. Right, so this is another challenge, sort of financial stability challenge, particularly for countries with high leverage. And of course, the topic of fiscal space and government debt financing is once again very important. And last year, in many emerging countries, it was domestic financial system, domestic banking system, which financed a significant part of this extra issuance of government debt. And it's not clear whether domestic financial systems have this space now, right? Whether it was completely used last year, how much is still there in order to finance it, given that capital flows becoming less stable. And one more thing about capital flows. Last year, I think capital flows to many emerging markets recovered quite fast after stabilization of financial stability risks came out of the concern, because countries were decreasing interest rates, right? And so lots of investors were trying to earn money on those capital gains when interest rates were going down. And now many countries may stay with easy monetary policy from last year, but I think further easing is not so much expected anymore. So it may affect capital flows by itself as an additional factor, right? And it may be another impact of inflation or increased inflation expectations on stability of capital flows this year. So I think that there is a number of new challenges which we may see this year. Speaking of Russia specifically, in a sense, we are in a sort of more favorite position because what we saw a very interesting development in the fourth quarter last year and first quarter this year. We expected, since there was a second wave of COVID in the fourth quarter, we expected that we see deflation in the fourth quarter. But as I said, it started to be inflationary, and we also expected that recovery will significantly slow down or will even go into negative side once again after the quick recovery in the third quarter. But we haven't seen that. So it looks like our economy adopted much more to the second wave of the pandemic, demand recovered, both maybe because there was government support and the economy was much less closed than during the second quarter, so many businesses worked. So all of those production bottlenecks and particularly import bottlenecks started to reveal itself. Import grew actually by more than 20% in the fourth quarter, so there was a huge increase in demand for import, but we know that there are bottlenecks and some specific products on the global markets which affect production, affect inflation. So it probably was visible in our economy as well. So we are actually already we have already started slow monetary policy tightening, right, or neutralization of monetary policy. As we said this, we had historically lowest in the last 20 years central bank interest rate, so we already increased it by 25 percentage point. Speaking of capital flows, yeah, we don't see, we think that the situation is kind of stable. I don't think we see really massive effect of increase in yields in the US on capital flows. I think that there are two factors which compensate one another, because US economy is expected to recover quite quickly this year. So this effect compensates the effect of rising yields in terms of capital flows. But again, maybe for our idiosyncratic reasons, maybe for other reasons, but capital flows are not as strong as they could have been in some other periods, like last year or for the years before. And that's probably also related to the fact that we are on another point in our monetary policy cycle right now. Saying that, we never did any QE. Russia, we think that we do not have enough credibility as a central bank, and we think that it's maybe a road toward losing central bank independence. So we are very careful about QEs. We think that it can bring short-term gains, but longer-term risks. So we haven't done it before, and right now, although we never exclude that we can, in some situation, do it, we think that we will try to use other instruments which we traditionally use in order to stabilize the market, rather than buying government bonds on the central bank balance sheet. Let me stop for now. I'll answer questions later. Thank you.
Thank you very much, Ksenia. You touch on a point, the inflation threat, the inflation risk, which of course is something that we are monitoring very closely. I'm sure that it also in the Q&A, there are already some questions that I received in advance of the panel where the question was, and I will come back on that, to what extent the threat of inflation creates a change in the monetary policy, of course, of central banks. That's the bottom line of the debate about inflation, I believe, of inflation risk. Let me move immediately from Russia to Africa. So it is a pleasure to give the floor to Fundi Tshazibana from the Central Banks of South Africa, so we can provide another perspective in terms of the implication of pandemic on South Africa. Please, Fundi, the floor is yours.
Thank you very much, Mas, and it's a great pleasure to join my colleagues and being part of this esteemed panel. I would agree with the points made earlier that as emerging markets, we're not out of the woods. And I'm going to echo pretty much what Ksenia has just outlined about the fact that we are facing different challenges during 2021. And the challenges are going to require us as central bank to be considering more immediate trade-offs. And we also have to think about longer-term risks as a result of our policy responses. And certainly as emerging market countries, I think it's quite important for me to upfront talk about the variability that there is among emerging market countries, and that this has been driven by differences that we've had in terms of the policy space that we've had to respond to this crisis, the differences in economic structures and existing rigidities, alongside some vulnerabilities that many of our countries have. And the big question that this raises in this current environment is whether the easy financing conditions and the investor appetite that is there at the moment is likely to continue, and whether it will be the same for all countries. And our assessment in the South African Reserve Bank is that there is substantial differentiation in financial markets between countries at the moment. And countries that have got higher debt levels, and that have got vulnerabilities in terms of their external positions are likely to find themselves facing some abrupt reversals in capital flows, and they might find their currencies under pressure. So I just want to take some time to talk a little bit about the currency issues. So a combination of rising US bond yields and a stronger dollar, as we've seen recently, could pose some challenges for emerging markets. So while a stronger dollar may not necessarily affect competitiveness of emerging markets because of broad-based dollar invoicing, it may disadvantage dollar-based investors to increase their exposures to emerging markets. So we think that that is a risk, that we might see some shift in investor appetites, or at the very least, it would entice investors to continue in the trend that we have seen over the past 2 years, where investors are choosing more hard currency assets over local currency assets, which we as emerging market countries have worked very hard on over the last while. Let me just talk about South Africa, just to reflect a bit more on vulnerabilities of countries that have got higher levels of debt. So the South African government provided a 500 billion rand economic support package over the past year. As a central bank, we responded by cutting interest rates to the lowest levels that we've had in over 20 years. And we were allowed to do this by benign inflation conditions and the moderation of inflation expectations. However, the weaknesses of the South African economy in the run-up to the COVID crisis have not disappeared. If anything, government has had to ramp up its borrowing, and this has had a big impact on how investors perceive the South African credit. At the same time that many emerging market countries were dealing with capital flow reversals, we actually had a downgrade of our sovereign rating. So we have moved further and further away from our investment grade rating, as a number of investors have got concerns about the credibility of our fiscal framework. So we are entering the post-COVID crisis with higher deficits and higher debts, which is placing us at a disadvantage. And for us, there is no escaping the fact that during this period, we have to think more strategically about structural reforms that we have to put in place. Because while we have seen the large fiscal injection, investors are asking significant questions about what is the funding going to be used for, in addition to the health response, in order to restore the growth path of the economy. A second point that I would like to make relates to QE. And I think Ksenia made some important reflections on countries that have embarked in QE. So in South Africa, I would call it QE light, in that as a central bank, we have purchased bonds in the government bonds in the secondary market, primarily for market functioning purposes. There was a lot of unhappiness, of course, within certain quarters in the economy that the central bank was not purchasing government bonds directly from government, which is in the primary market, but we had to take a decision as a central bank when we were considering the elements around the credibility of the central bank, the longer term trade-offs at stake about whether this is something that we would be willing to entertain. So as with Russia, we think preserving central bank independence is quite important. We have been quite successful in tapering our interventions in the government bond market, and it's largely because we had specific objectives when we went into the market to deal with dysfunction elements that were there, and we have been scaling back quite successfully. In conclusion, I think that the main points I want to reflect on is that there are some country-specific issues that we cannot run away from, that I think that the post-pandemic environment is going to require us to deal with head-on, and these structural rigidities that I referred to would be one such element that we have to think about as emerging market countries. Policy support is quite essential for recovery, but we require careful calibration of our policy responses to ensure that there are no unintended consequences. And in light of the mobility of capital alongside other domestic factors that a lot of us have had to deal with, and the primary one being the high debt levels, we do have to put in place sustainable recovery policies in order for us to get back to a sustainable footing. I think I'll stop at that, and then I'll come back in on specific interventions. Thank you.
Thank you very much, Fundi. I think you raise a lot of additional points. Let me mention maybe I like two. One is about the impact that, of course, the US dollar and the yields in the US can have on the demand for emerging market debt. I think it is a very important point. For instance, I deal mainly with the reserve manager. I saw over the years how much the differential in the US interest rate in favor of the US has provided a strong support for treasury in the central bank reserves. This actually came out completely as a result of the pandemic, when the US interest rate in the end converged toward the zero level already prevailing in Europe and over in Japan. Now we think that we thought that this situation might persist for a prolonged period of time. If this situation reverses, we are going to see once again the US dollar denominated asset, in particular the treasury, becoming relatively more attractive, largely because of the higher carry that they can provide. And this, of course, is negative for EMD. And the second point, which I also find very, very interesting, also in the light of the opening remark of Ṣebnem about the medium to long-term challenge and the need for structural reforms. In Europe, we talk about sustainability, infrastructure. In the US as well, probably also emerging markets need to start addressing structural issues in order to position themselves for long-term growth, which is ultimately what we are all aiming for. So we heard from Russia, we heard from South Africa. Let me move now to a country which is a little bit close to Europe. So I think they are probably feeling much more the impact of the slow distribution of vaccine across Europe when compared to UK and the US. So I give the floor to Marek Mora, the Deputy Governor of the Central Bank of the Czech National Bank. Please, Marek.
Good afternoon from Prague. I would like to congratulate Fundi on the 100 years of the Reserve Bank of South Africa. Very impressive. They are 5 years older than we are. I was impressed by that. I learned something new today. Let me make my presentation in 3 parts, and I will try to be as brief as possible so that we have some time for discussion later on. I will speak about the starting conditions of the Czech Republic before COVID, then I will say something about the measures which we adopted, and then the last point will be on the outlook and the risks which I see. The starting conditions for the Czech Republic before COVID, I would say they're quite good. We had ample monetary policy space. Our main monetary policy rate was at the level of 2.25. For the conditions in the EU, because we are still very close to the Eurozone, was not bad at all. We had also quite strong fiscal position. Our fiscal space was good. Our public debt was at the level of 30% of GDP before the crisis, which was among the lowest in the EU, the 4th lowest level of public debt in the EU. We had a very low, actually historically the lowest unemployment rate of 2% historically in the Czech Republic, and also the lowest in the EU. We also had a strong banking sector, very good, very well capitalized, very low share of NPLs, very high return on equity. So the conditions were quite good. GDP per capita measured in purchasing power were at the levels of Italy and Spain. So we have been converging, though one must say that, especially in the case of the Czech Republic, there is a difference between GDP and GNI, because we have lots of foreign workers and also lots of foreign capital. The banks, for instance, are mostly in foreign hands. So there is a difference, but still GDP is a measure of development. Also, our monetary policy framework, I think, was quite credible. Almost since 25 years, we have had inflation targeting, since now 23 years, with a managed floating system. So people are used to it, companies are used to it, households are used to it, the state, the government is used to it. We have a very low level of dollarization, in our case, probably euroization of the economy. The euro is not used, or dollar, almost by anyone. It is partly used by non-banking corporates, also partly by banks, but not at all by the households. So we don't basically have these typical problems of an emerging economy as we heard of. As for the measures introduced, I mean, we did plenty of things in the Czech National Bank. We decreased our monetary policy rates by 200 basis points from the very beginning in 2 steps, which I think was not bad. We did not employ a QE. We also relaxed our monetary policy operations. We increased the number of counterparties to non-banks and also the set of collaterals. But basically, we never used these operations. We announced them, we prepared them. But as the Czech Republic financial sector has a huge surplus of liquidity, we didn't have to use these measures. We also took some steps in macroprudential policy, because the Czech National Bank is also the sole macroprudential authority in the Czech Republic. We decreased the countercyclical buffer by 2% by 1.5% from 2% to 0.5. We also relaxed conditions for mortgage loans, and we also initiated something which was not liked, especially not by the bankers, but which was then later on adopted across the EU. We namely initiated the postponement of the payouts of dividends for banks, insurance companies, and pension management companies. Later on, it was adopted, as I said, across the EU in order to stabilize our financial sector. We also initiated the loan moratorium, which we applied for half a year between May and October last year, but it was a law which was adopted by the Czech Parliament and prepared by the Ministry of Finance. The main role in this crisis was played, as in other countries, by the government, and it was mainly the fiscal policy. As I said, we had plenty of fiscal space. Automatic stabilizers were used, of course, but also plenty of ad hoc COVID-related measures were introduced aimed at employees, self-employed people, companies to provide liquidity, etc. But there was one thing which I think distinguishes the Czech Republic from some other countries, at least to my knowledge, is that the Czech government at the end of last year also introduced a structural change in the fiscal policy. They decreased taxes by 100 billion Czech crowns, which is some 1.5% of GDP, which is quite a lot. And I don't think there are many countries which would make during the crisis such a big structural change but I might be wrong. Maybe there are some, but I think most of the countries, as I said, used only these ad hoc COVID-related measures, and of course they were automatic stabilizers at work. So last year our fiscal deficit was 6.8%, which was for Czech conditions quite a lot, and that level increased from 30% to 38% of GDP, which is, as I said, for us in the Czech Republic, something unusual. And now there are already some people saying that if we continue like this, very soon we will have to face something which we call a debt break, under which very special conditions will have to be applied for the preparation of the state budget. As for the outlook, so far, actually, like in some other countries, we were quite surprised by the low degree of disinflation. We actually expected that the disinflationary forces would be much stronger during the COVID crisis. They were not. We had our inflation at 3.9%, and now we are slightly above 2%. 2% is our target. So we are still above our target. We thought the inflation would go below our target, but it did not. We were also surprised by the strong reaction of our economy to the removal of the restrictions in the economy. We had several waves of COVID, but each time when these restrictions were removed, the economy reacted very strongly. Especially our industry is doing very well. Now in the autumn, it is quite strong. It's strongly linked to Germany, and we think we also profit, and it is one of your questions, that we profit actually from the strong business link or trade link between Germany and China. So we are doing well, and we expect in the second half of the year to recover. But of course, as Max very rightly said, it very much depends on the speed of vaccination and how quickly we will get things under control. If I may say, that I would see two challenges for the Czech economy, and they are both lying in the financial stability area. Of course, the inflation outlook is something which we watch very carefully, and we were basically one of the very first central banks in the world who said already, I think in autumn last year, that we would see some hikes on the horizon, and some people considered us to be crazy. How can someone speak about hikes in the middle of the crisis? But we still thought that one day there would be an end of this crisis and the economy will recover. But so this is something which we think we will have under control. We will continue having it under control, is inflation. But we are very watchful of this. But we see I see two concerns in the area of financial stability. Two of them are domestic. One is real estate prices, which are increasing, which is, again, a bit of a surprise to us. But I think it's not something which is unique to the Czech Republic. One sees it across the globe. And actually, we all thought that people will behave in a more prudential way, and maybe they do in that they are buying, more properties. But let's see how things will evolve. And the second part of our domestic concern, my domestic concern, is the evolvement of public finance, mainly due to this structural change, which was introduced at the end of last year, as I said. And if I should see one foreign possible risk, then I would be a bit worried about the development of the Eurozone financial sector. There I could see maybe a risk of the second round of the crisis, as we saw after the great financial crisis, where Eurozone got its own crisis later on in 2012 to 2013, which was partly linked to the development of the financial sector. I will stop here. Thank you very much.
Thank you very much, Marek. We will come back on the question of inflation. I can hear some music about inflation risk rising across the board, and I'm sure we need to go back on that, about the implication for EM. But we will go back at the end. I would like, before to move west once again towards Latin America. So it is a pleasure actually to give the floor to Roberto from the Central Bank of Colombia. Mr. Steiner, please go ahead. The floor is yours.
Thank you, Max. I guess everybody's about to have a birthday soon. Our central bank will turn 100 2023. So I guess we're all more or less have a common history to share there. Like Marek, let me start by saying regarding the initial conditions, before all this mess started, the Colombian economy was performing relatively well. inflation was above our target, and interest rates were quite high. They were 100 or 150 basis points above inflation or expected inflation. And as soon as the pandemic hit, we did what most everybody has done. I can be very brief. We acted very swiftly to stabilize markets, including foreign exchange overshooting and developments in private and public markets. When that happened, we moved to more supportive policies. We did something that we probably should have done years before. We brought down our very high reserve requirements, and we brought down the policy rate quite significantly. Not as much as our neighbors, for example, in Peru and Chile did. They moved their interest rates close to zero. We could not do that because inflation and inflation expectations were much higher in Colombia, but we did move them into negative territory in real terms quite rapidly. And we did all kinds of tinkering here and there to stabilize markets, both in foreign currency and domestic currency. Nothing that does not sound familiar to any of those, to all of us in this meeting. The fiscal, of course, moved in the same direction as Marek was saying. Apart from automatic stabilizers, there was an important fiscal impulse coming from additional expenditures. And things were more or less moving in the right direction under the expectation that the pandemic would probably disappear in 2021. The bad news is that we're still there. And this conventional policy stance of an accommodative monetary policy, of an expansive fiscal policy, which makes all the sense in the world and everybody's doing it. The risk now is, how long can we sustain this? And the Colombian experience is quite different from what we've been hearing in the case of Russia, in the case of the Czech Republic, and probably in the case of South Africa. Our inflation target is 3%. Inflation is now running at 1.5%. Inflation expectations are quite higher. They're closer to 2.5%. But inflation is not a big risk at this stage. Our concern has to do with the fiscal. And the fiscal, in the case of Colombia, is interesting, and I think it brings important lessons to other countries, and I would like to share that with you. We have had a strong policy framework for many years on account of that. We were one of very few countries to access the flexible credit line of the IMF on account of having strong economic policy and economic institutions, including inflation targeting with a floating exchange rate regime. We've had that for 20 years. It worked well. And we also had a fiscal rule that apparently, it got very good grades from everybody, from the credit rating agencies, from the IMF. But some developments in the fiscal are an issue of concern. And that is important to highlight, because even though our fiscal deficit at around 8% is not particularly large given what's happening all around the world, in the process of complying with a fiscal rule, Colombia experienced an important increase in debt. We should focus not only on flows, we should look very seriously at stocks. And anybody willing to understand how fiscal rules work should take a good look at the case of Colombia, because we have been praised for many, many years for abiding by a fiscal rule, which established targets for the structural fiscal deficit, but had no anchor for debt. And in the process of complying with the flows, the stock of public debt went up from 30% of GDP in 2012 to around 50% before the pandemic. We already had quite a high debt burden that, of course, has risen significantly on account of the pandemic. So the public debt burden right now stands at 65% of GDP. So even though, here I take a word from Marek, even though currency mismatches are not important at the corporate level, currency mismatches are non-existent at the household level, and even though 2/3 of public debt is issued in local currency, the fact is that the debt in itself increased so much that public debt issued in foreign currency went from 9% of GDP 2 years ago to almost 30% of GDP as we speak. So even though we can still say that most of public debt is issued in local currency, the amount of debt issued is so big, has increased so significantly that at this stage, we're talking about almost a third of GDP, government debt being a third of GDP issued in foreign currency. This is a risk that you probably don't want to have in the current situation in which the perspective for higher interest rates in the US, for a stronger dollar, that's not necessarily the position you want to be. And interestingly, it is putting the central bank at odds, because even though by looking only at inflation, there is ample room to continue with a very supportive monetary policy, when you look at the fiscal, then you're not so sure you can reach the same conclusion, because at risk is the fact that the government will lose its investment grade, currently held by the 3 credit rating agencies, and in the new context of higher interest rates in the US, what will happen to our currency? What will happen to our ability to access capital inflows to finance this huge debt burden is something that we never thought we would face when we started loosening monetary policy a year or so ago. So it's interesting. It's not only interest rate, it's not only inflation. Inflation is low. Inflation expectations at this stage are reasonably well anchored, but the perception that the fiscal might really become a dominant factor in our ability to undertake an independent monetary policy, it's now at stake. And believe it or not, while the whole world is spending its way out of, trying to spend its way out of the pandemic, the Colombian government, as we speak, is submitting to Congress an important fiscal package to actually reduce quite significantly the fiscal deficit by means of a significant hike in taxes. We are at this stage with a loose monetary policy, but now facing the need to actually tighten fiscal policy. The central bank has been very supportive of the government's intention to strengthen its fiscal position, because we are under the belief that if the fiscal situation is not corrected soon, or if important measures are not undertaken that send signals that the fiscal deficit will be handled appropriately in the near future, then we are concerned that we will lose our ability to actually do what we've been doing for the last year or so, having a very supportive monetary policy, allowing the exchange rate to fully float and move wherever it has to go. We are under the impression that if the Colombian Congress does not deliver on a significant fiscal package that is now being submitted by the Congress, then we are at risk of not being able to continue supporting the economic recovery by means of a very supportive monetary stance. So really, a lesson that comes from Colombia is that let's take stock seriously. Let's not only look at flows. And now, if you look at the last article from the IMF, there is also the call from the IMF, hey, Colombia's fiscal institution probably wasn't as good as we all thought. We were all looking at flows. They were complying with fiscal deficit targets. And in the process, the debt burden went from 30% of GDP to 50% before the pandemic. It's now like 65% of GDP, and it's certainly constraining the ability of the central bank to undertake countercyclical monetary policy. Another issue, and I would like to come back later, is on Colombia's experience with the flexible credit line It's one of the few countries to actually access that facility, and it's the only country to actually have used recently some of the IMF resources to fund the fiscal fund fiscal outlays. I would leave that for a second round, but I think that experience of Colombia with the IMF facility is something that is probably of interest to many of us who are listening to us today. Thank you, Mark.
Thank you very much, Roberto. I think you raised a very important point, which is fiscal sustainability, and I would like to touch upon that later. We have exactly 15 minutes, and I really would like to focus on three topics, which are the one which I heard from all the panelists. The first one is the question of inflation. The second one, of course, is the question of US dollar yields and capital flows. And the third one is more about down the road, the public debt and eventually fiscal tightening. So let me, if you agree, we can do this very quickly by asking a flash from each of you on one of these topics, and we can follow the same order that we had for the initial remarks, if you agree. So my first question on inflation is very simple. I deal with this question with clients and investors daily now. Are we facing an inflation risk down the road? And if yes, what would be the implication for emerging markets? Of course, the question can be the answer can be different depending which emerging market you are, a commodity exporter or not. But I think it is a very important question because it will have repercussion across the whole policy making. So maybe we start again with Ṣebnem.
Yes, let me make 3 points. First of all, the point on heterogeneity of emerging markets is extremely important. A commodity exporter and a commodity importer is going to look at it from a very different lens. So we have to really keep that in mind. Inflation risk in terms of US and advanced countries, I think that's a little bit over-exaggerated because I believe US Federal Reserve is on top of its game, and they can manage the inflation expectations. And yes, there is going to be inflationary pressure, but I believe US Federal Reserve is going to handle that. Of course, a global inflation in terms of oil prices and commodity prices and all that, that's going to go to the emerging markets. But there again, emerging market heterogeneity is very important, and the risk sentiment of foreigners is going to be very important. That's why I think capital flows are central here. As I showed very clearly in my Jackson Hole paper from 2019, the heterogeneity in emerging markets is going to be exactly the heterogeneity of the foreign investors' risk sentiment. So the countries that are more risky are going to be the ones that are going to lose capital outflows quickly, are going to be the ones where inflation is going to pass, depreciation is going to pass through inflation quickly and all that. So that's, I think, very important, that foreign investor risk sentiment, which is again going to be tied to US long rates and US monetary policy, is going to play out differently on emerging markets. And I would like to make one point here, because that's also going to affect the exchange rate, right? I mean, so when we say if dollar is going to appreciate or depreciate, dollar is going to, of course, appreciate according to relative to all these risky countries, right? But it might depreciate relative to other safe haven countries. So there are going to be several issues here that is going to be important in terms of understanding this. And finally, this whole fiscal monetary mix, I mean, this is a little bit new concept, as I understand, in advanced economies, but this is very well understood in emerging markets, as was clear from Roberto's point. I mean, emerging markets dealt with this all the time, and we all understand a successful inflation targeting, successful monetary policy requires fiscal discipline, requires fiscal backing. And this entire sense that, oh, look, emerging markets finally doing counter-cyclical monetary policy, that is not correct. If you look at taper tantrum, if you look at Lehman, many emerging markets cut the rates, actually. This sense that, oh, they have to increase the rates to get the capital flow back. This was the days before successful inflation targeting. Once they're in the world of successful inflation targeting, which is after 2000, they very much running counter-cyclical policy, and they understand the success of that type of counter-cyclical policy and inflation targeting backed up by central bank independence and fiscal discipline. So let me stop here.
Thank you. Ksenia, let me turn to you. You mentioned the appearance of some bottlenecks in the Russian economy in your opening remarks. What's your perspective on the inflation risk and the implication for emerging markets?
For Russia, we think that inflation risks are quite substantial, and they're not only driven by external inflation, but also by domestic inflation. We think that economy is recovering quite fast, so we see some demand pressure. So this is why we already started neutralization of monetary policy. And of course, for us, the problem is inflation expectations. It's our 6th year of inflation targeting. So we earned a lot of credibility, but it's not enough. We haven't anchored inflation expectations fully yet, right? That said before that QE, how advanced economies use QE, they use it also to increase inflation expectation. It's not we can afford, right? We need to stabilize inflation expectations. So for us, we consider at this point inflation as a risk and not only important, but also domestically recovery driven. On your last point on government debt and then fiscal, etc. Russia is known in the last 20 years for fiscal discipline, and we as a central bank fully back that. We think that this is our asset, that we have budget rule, that we have responsible budgetary policy, that we have one of the lowest debt level in the world. And we also think that as well as it's appropriate for monetary policy to now start reacting to inflationary risks, it's also appropriate for the government at this stage of the recovery to start thinking about going back to the normal budget rule. We understand that not all countries are in the same position as us. Right, I hear from Colombia that they face very different risks. And this is why I said that this increase in inflation expectations, increase in long-term yields or interest rates it puts many emerging countries in front of trade-offs, both in monetary policy, in fiscal policy, in financial stability, because high interest rate for leveraged companies, for governments with significant debt is a significant challenge, and central banks need to think how to manage both financial stability and monetary policy in this situation. So I think that this is an important factor which would affect our policy in this year, in 2021 at least. Thank you.
Thank you. And I will go back to the fiscal situation with a question as a follow-up also from the Roberto remark. Fundi, what's your view on inflation? Do you see this as a risk in South Africa?
Well, in South Africa, our inflation is largely going to be within target for the next 3 years. However, there are some risks similar to those seen in other countries, food prices, oil prices increasing. But broadly, I think the decision we took as a central bank to anchor inflation expectations and to communicate clearly our preference of having inflation within the midpoint of the inflation target was a very good approach on our side. In South Africa, what we found was that as COVID, as the pandemic came through, our inflation actually went down. In fact, our concern has been on the opposite end, in that the concern has been that we would be undershooting the inflation target. We do have an inflation target band, which is 3 to 6%. So we've seen a positive impact in that inflation expectations have come down from 6%, which is where they were anchored for the past few years, and they are firmly within the midpoint of the inflation target. I should just stress, however, that we are concerned about the impact that fiscal risks have on monetary policy. In fact, over the past year or two, this has been an area of focus. And for South Africa in particular, this had an impact on the country risk premium. So far, we are lucky in that when we think about the country risk premium and the impact on the exchange rate, that has been moderated by the fact that we have had low pass-through from the exchange rate through to inflation, because demand conditions have been quite poor. So far, so good, but this is an area that we're monitoring quite closely.
Thank you. And Mora, we already heard from you that you have some issues about inflation in your opening remarks. But let me put I will not ask you the same question. Let me do a follow-up. I remember that during the euro area fiscal crisis, during the euro area in the past, the ECB has been blamed for acting too soon, to tighten too soon. We still remember what happened in the early, about 10 years ago now. Do you think there is a risk as well that this might happen again, especially if we start to see inflation expectation going up? I can see the hawks in the ECB eventually turning even more, starting to ask for a slowdown, not only of quantitative easing, but eventually starting to withdraw liquidity. Do you see that there is a risk? I know there is a risk for your country also because of the impact that this could have on your exchange rates that you try to maintain stable with a lot of intervention for a very long time.
Yes, thank you for the question. I would prefer to answer on behalf of the Czech Republic. I don't want to speak for my colleagues at the ECB, but
of course.
I personally think that there is more risk in tightening too early than too late. We also communicated that it is a lesser mistake to do it a bit later than too soon. And we also linked it in the Czech case to the condition that we want to see the COVID situation to be much more under control than it is now. Only then we will start tightening. And as I said, we think if we tighten a bit later is less of a mistake than if we do it too soon. And we think it could happen in the second half of the year, but we will see when.
Thank you, Roberto.
But we are not worried. We are not worried of the inflation development. We think that we will have situation under control in the Czech Republic. Thank you.
So if I can slowly, by using the link between monetary policy and fiscal policy, to shift over the fiscal policy and ask a little bit a devil advocate question. So for sure, the fiscal policy can create some constraint on the monetary policy. And I think Roberto pointed out very clearly. So I have a question which I want to be a little bit provocative. Is there a risk of central banks in emerging markets being required to monetize this public debt down the road, considering the fact that we know that this public debt eventually, once the pandemic is over, will have to be tackled? Is this a concrete risk or not? Or we are beyond that point because this is something of the past? And I started maybe from Roberto, because I know that in Latin America, this pressure is not something historically uncommon.
Thank you, Max. Well, Colombia is not your typical Latin American country, fortunately.
I know.
And we have generally not monetized our fiscal problems. The central bank charter, as rests in the Constitution, does not allow the central bank to directly finance the government unless the 7-member board unanimously votes for that. We've had an independent central bank for 30 years, and no direct credit has ever been issued in favor of the government. Is there pressure for that? From political parties in the left, there has been the mention of monetizing debt. Unfortunately, some members of the business community who think that it's a better idea to monetize debt than to hike taxes have also support you. But fortunately, the government, starting by the Minister of Finance, but including the President himself, has said unequivocally that using central bank financing will only be the case if all other options for financing the fiscal are ruled out. And at this stage, one can think that Colombia's possibility of financing its fiscal deficit is getting more complicated. Money is becoming more expensive, but nobody's thinking that Colombia will be priced out of markets. So the possibility of financing the deficit at the central bank at this stage, I think, is not there. It requires a unanimous position by the central bank board, which means that people like myself actually have veto power. So I don't envision that happening anytime soon. So we will continue to be an outlier in the Latin American context, fortunately for all of us. Thank you, Max.
Ṣebnem, I can see you want to say something.
Yeah, because this is very important. I think this point is misunderstood. QE is effectively debt monetization. Okay, so there is no difference. There is no technical difference between printing money through open market authorization or monetizing the debt. Please go back to Ben Bernanke's testimony after the Lehman, when US started the QE. The difference is this: if you permanently fund government, then it becomes debt monetization. So for credibility, so QE not turn into debt monetization, you have to have an exit strategy. You have to have an exit strategy that I'm going to do this temporary, I'm going to get out, and I'm going to normalize at some point. That's why it is successful in US and Europe. And people think emerging markets.
Yes.
The emerging markets can't do that. with credible monetary policy and central bank independence and fiscal backing. So it is about if you are funding your government permanently or not, and that means if you have an exit strategy from QE or not. So otherwise, technically, QE and debt monetization is exactly the same thing.
I don't disagree with that, but let me maybe make it clear. Central Bank of Colombia has not undertaken any QE in any meaningful sense.
Yeah. No,
I'm not talking about either. I'm
answering Max's question is emerging markets all permanently going to be in this world that there? So this is like 1980s and 90s. So that's why I want to explain that.
Absolutely. And Ksenia, I want to say something. Let me say something before that it is different if, of course, you're issuers of a reserve currency or you're not an issuer of a reserve currency, because QE in US and the Euro area is one thing. QE in an emerging market economy is something different because the risk is much higher, of course, for the latter. Ksenia, I think you wanted to add something on this topic.
Yes, what I wanted to say is that for some countries, and my understanding is that Colombia is probably on this list, it's not really an issue that the central bank would be monetizing the debt or not monetizing the debt, but expectations of the market may change, right? So the market may react on fiscal position itself, right? So the risk may come from the market sentiment, not from the policy. So this is a very big
absolutely yes
for many emerging markets, and it's definitely much smaller or non-existent in advanced market, not in reserve. Even in the US, we saw that failed auction. I still don't understand why it failed. But anyway, I think that from this perspective, emerging markets are in a different position.
I fully agree. This is exactly what I show in my Jackson Hole paper. It is the emerging market specific risk sentiment, and that's exactly why U.S. monetary policy is very important, because that affects the global risk sentiment, and then from that you go to these areas, emerging market specific risk sentiment. Of course, every policy emerging markets too will affect that risk sentiment, but it is going to come back to risk sentiment because there's already high level, exactly as Ksenia is saying, and depending on how much you mess up, you can increase that, and that's going to affect directly your external finance premium. I fully agree with that.
And let me take that. Unfortunately, we're running out of time. I love the lively debate, and we have more questions coming in. But unfortunately, I know that you are all a very busy agenda. You probably have to jump on another Zoom call for something else. So let me maybe sum up and wrap up very quickly, because I think it was a very nice panel, and I think a few important things came out. With the problem of inflation, there is a feeling that we have a strong demand driving inflation, because the recovery is probably even stronger than what we were expecting, I would say, a few quarters ago. I think that's something that we saw happening through time, this pandemic. Every time that we close, the impact was more muted, and every time we open, the recovery was probably faster than what we were expecting. And I believe this is because we always underestimate the ability of individuals to adapt to the new circumstances. And we are seeing exactly that happening. And of course, we can have some bottlenecks emerging here and there, which eventually will push up inflation. But there is no consensus on the fact that inflation is something unavoidable down the road. It seems to me there are different views on that. That inflation might not materialize. I'm, for instance, in that camp. I believe it's a structural factors which keep inflation down. These are not going away. Technology, globalization, we should not forget about that. So that's one aspect very important. But I think what is interesting is the interaction between the monetary and the fiscal policy. And it seems to me that what emerged is that there is more concern from an emerging market perspective about fiscal sustainability over the medium-long term, because eventually all this fiscal expansion, which was probably unavoidable, and so the move away from a rule-based type of fiscal approach, in some way will have to be rein sooner or later, and this poses a lot of risk, I would say, in terms of growth prospect. And of course, here the heterogeneity of the countries, as Ṣebnem pointed out, it becomes fundamental, because it is much easier to do it when you have a good capital inflow, no inflation. You can really start to rein in the fiscal expenditure, while it is much more difficult when you have low growth, capital outflow, etc. So the final point on the US dollar and capital flow, we didn't touch upon that. So I take it as a fact that we don't know whether the US dollar will eventually weaken, as the consensus say, or eventually will reinforce. But I think if the dollar will rise in tandem with yields, this will definitely decrease demand for emerging market debt simply because the carry still matters in the fixed income market. With that, I really would like to conclude you. I am very happy that the panel, I'm very happy that the technology worked. We didn't have any major interruption. And I really wish you all the best for the continuation of your virtual meeting. And I hope to see you soon in person at the next IMF World meeting in Washington eventually. Thank you very much and goodbye. Thank you. Bye-bye.
Thank you.
Bye, Max. Thank you. Bye-bye.
Thank you. Bye-bye. Ciao. Bye-bye.
Take care. Bye-bye.
Take care. Bye.